Thanks for joining us. My name is Priya Kaftan, and I'm the head of investor relations and product strategy at Herd Capital. Herd Capital is an equity-focused investment manager that currently oversees about $315 million in assets across a long-short product and a long-only product. Today, I have the great pleasure of being joined by Matthew Wright. Matthew Wright is the founder and president of Disciplina Group. Disciplina Group is an OCIO firm focused predominantly on non-for-profit institutions. He and his team create customized solutions for their clients so that they can further their important missions.
Matthew, I want to jump right in and talk about 2021. The year's obviously started at a frenetic pace. We have short squeezes, we had a new administration. What are your thoughts on the year? Where are you spending time, and where are you hoping managers spend time?
Priya, thank you once again for inviting me to take part in this. Last year was a very, very wild and volatile year, and fortunately, we came out on the positive end across the board, across the markets and in our client portfolios. In 2021, I think we're still going to be going for it with a ride. There's several different factors. I think we could take the political component out of the landscape now. However, gridlock in Washington, how quickly we can get the vaccine enrolled, everyone vaccinated across the globe and in the US is really going to play into kind of the ebbs and flows of sentiment in terms of the markets. But big picture, rates are very, very low. There's a lot of stimulus in the system. And quite frankly, as long-term investors, what we do is we take a step back and we say, how should our portfolios be positioned for the long term? And in environments of a lot of uncertainty, we kind of pick our spots in terms of where we're going to make bets or tilts to enhance value in our portfolio, either directly within something like fixed income, where you're looking at various different sectors, whether you want rate exposure or whether you want credit exposure, or in terms of active managers in environments, really trying to assess the environments to see if they're right for those managers to actually perform well. We tend to assume, just like anyone else, if you think about an agrarian society, agricultural society, you just don't plant seed at one time of the year and expect it to grow. You try to pick the best time of the year when it's going to harvest the best crop. So that's what we're doing right now. We're trying to look at different facets and areas of the markets where we think the opportunities are going to be right, and then tilt our managers accordingly, and then tactically from a sectoral basis, if necessary, do that. We're invested in public markets, private markets, hedge fund strategies. We're also in natural resources areas. So again, we're having a lot of discussions with our managers reviewing 2020 and getting their thoughts on 2021. And we would anticipate that, over the next few weeks, we'd have a little bit more clarity of how we're going to kind of tilt and commit our capital versus our long-term targets.
And when you have those conversations with managers on the year past, the year ahead, are there lessons that you either gained from them or lessons that you've gained from your experience in the sector that you're hoping managers start applying to the year ahead?
I mean, our real key is if we do our job right in our whole due diligence process and our whole interface with our managers is building expectations of what they do best and really trying to parenthetically see if we're in a scenario or we're in an environment where they're going to benefit. We will have our relationships for long-term periods of time, but ideally we'd like to be in a situation where we would get a better IRR with our manager than a rate of return. And that basically means, kind of dollar weighting in environments that are more effective than others. Coming out of the year, there were a few lessons that were learned. I think the biggest one is that when we saw market extremes, to tilt the portfolio and have convictions that markets will correct. So that was a positive. I think another lesson learned was patience. When things got hit more so than we otherwise anticipated, particularly whether it be on the equity side or whether it be on the credit side, having the high conviction in our managers, knowing that what they're articulating to us and knowing that their process is consistent, that there will be a recovery and the fundamentals will play out and the returns will come forward. So that's really it. Playing the extremes and looking for opportunities, definitely a lesson learned from our managers and within our team, and then patience. Those were really the keys. And hopefully we'll be able to apply those two things going into 2021 as well.
I want to shift gears a little bit and talk about diversity. Diversity has been part of the ethos of Disciplina since you started the firm. It's obviously taken greater scale in 2020. How are you advising clients, and given your leadership in the space and early adoption of the benefits of diversity to client portfolios, how have you seen those conversations change?
It seems as though in the marketplace with our existing clients and those that are inquiring about potential mandates with us, that diversity has taken a more vital role. We view it really as an opportunity to access talent across a broad spectrum. And if you take that context, really coming back from our endowment and foundation days, where it was very, very highly competitive and our returns were measured against other institutions, it really forced us to develop a process that was very much akin to diverse means. You take away systemic barriers such as number of years of track record, whether it be 5 years or 10 years. You take away size factors. You take away a number of those systemic elements that many in the institutional marketplace use to select managers, or quite frankly, screen managers. We take those away. And by doing that, it provides us a broader range of managers to consider. And oftentimes, many of the managers that were excluded in the more systemic and structured institutional process that has been in place for a number of years across a number of institutions, particularly consultants, start to come to the fold, and they start to rise up when you start to compare their performance versus others. So one, it's a natural extension of who we are. And then two, I think it really stems from starting off our careers in an area where we were open and competitive and accountable for our returns, and really, really mindful for identifying talent that could provide us differentiated performance, either in terms of returns or diversification versus our peer institutions. And that just translates into, what we've done for the past 20 years, and we'll continue to do that. That could be domestically, it could be abroad. So we always have gravitated towards small niche managers, independently owned, employee-owned institutions. And again, that really just opens the door to look at diverse managers across a number of different strategies.
I'm sure here the audience hearing that your focus on small and niche managers is going to be music to their ears. Given how long you've spent in the space and given your experience, are there qualities that you have found to be better indicators of success amongst that group of small and niche managers?
Sure. So, and I'll try to unpack that in a number of different ways. So typically small and niche managers have a certain area of specialization, and that piques our interest. By having that narrow specialization, it's just differentiated by design from other things that are out there that are a little bit more commoditized or standard. So that's point number one. Point number two, going down that path, you tend to find managers that are employee owned and operated. So that means that they kind of control their own destiny. And then from an allocator or an investor standpoint, they don't have this large organization that distance us from the actual decision makers. We like that because when we're having conversations, we can have conversations with the founder, who happens to be also the chief investment officer, who has actually picked the team. So we can actually build a relationship, and that relationship, which translates into our due diligence, becomes kind of the framework and the guidepost, and we can always refer back to that when we go through periods to really vet whether or not we believe the strategy can continue to fulfill what we thought it could, which is good performance and differentiated returns. The final piece of the puzzle with that structure, obviously niche strategies, employee driven, is these firms tend to be capacity constrained too. So what that means is they're not trying to be asset gatherers and be all things to all people. So with that, they have acknowledged that they're very, very good at something. They're going to stick to their knitting, and that affords us the opportunity to pretty much partner with them and go along for the ride. When you start to get larger and larger in size, a lot of those elements that I talked about start to get diluted. and the alignment of interest from our vantage point with the investment managers that we're partnering with start to diminish, and it makes it harder to stay the course during difficult periods.
Can you tell us a little bit about Disciplina and why you founded it and what you hope to achieve for clients?
Sure. My partners and I worked together at both Emory University and Vanderbilt University for 12 plus years, and both very, very sizable, large, multi-billion-dollar endowments. And, we really came away with an understanding of kind of best practice in the allocation and access market as it relates to endowments and foundations from an investment standpoint, and really saw the gap in terms of performance from between our institutions and the smaller institutions. And we really launched this firm to really bridge the performance gap, because when you think about the opportunity, if you can bridge that performance gap, you're actually enhancing the missional capacity of a number of not-for-profits who are on the forefront, basically, not just in areas of education, but in terms of cultural arts, faith-based organization, social justice, civic justice, higher ed, healthcare issues. So it's really affording us the opportunity to do what we do well with firms and managers that we've known for a number of years, but really just spread the wealth of our experience, and then hopefully the stewardship that we provide for our clients in terms of advancing their mission beyond just the larger, billion-dollar plus institutions that we worked with for a number of years.
Right. Those missions are more important now than ever.
Yeah, absolutely. I think 2020 really shed a sharp light on the differential in a number of different ways, and we're happy to be at the forefront of that. And the wonderful thing in our work is that obviously we interface with our clients, but we celebrate their opportunities to expand their mission in terms of servicing their various communities or outreach programs. And those are real dollars that translate into real lives that can be impacted. And the fact that we have an opportunity to broaden our scope in applying that, it's very, very heartwarming and very, very gratifying.
So I'm going to steal a little bit from one of the podcasts I listen to, which is 5 questions, 1 thing. So I'm going to ask you 5 sort of speed round questions, and would love your quick take on your response. So what would be a word or a few words that you think best describe you?
Discipline.
Hence the name Disciplina.
Yes.
What is a quality or qualities that you look for in managers?
Transparency.
Number 3, your favorite non-work activity.
Family time.
What is a hidden talent or skill that broadly in your day-to-day work life people don't know about you?
I played baseball in college, and I still play baseball in a senior adult league. It's baseball, it's not softball, and it's about 4 or 5 months out of the summer, and I enjoy it heavily. It's a kind of a 40 and older league, and the guys throw anywhere from 60 miles an hour to 80 miles an hour, and I enjoy the competitive aspect of playing. So.
And your position, your favorite position or your preferred position?
Center field.
Okay. And last of the quick 5, what are you most excited for in 2021?
To get back out there, going to the office, but even more so going out and meeting with our managers. We've built a network and relationships over the years, and it's great to do Zoom calls. It's great to connect by phone, but it's even more better to actually greet with people, have lunch with people, talk to people, and just see how their businesses are growing and how their firms are evolving over time. So.
Well, we look forward to hopefully welcoming you back into our office. I really want to thank you for your time today. On behalf of Herd Capital, on behalf of Tide, it's great to get your perspective, and thank you again for taking the time.
You're welcome, Priya. It's great to see you, and I'm glad I was able to take part in this event.